You need to listen to this if you're a company director and you're looking for a mortgage. You can use a director's loan to support your mortgage deposit. This means you could be tax efficient by still releasing the funds from your company. Hi, I'm Jenny from Your Mortgage Hub, and I'm here to help those starting out or starting over with their mortgage applications by showing you what you should and shouldn't be doing when it comes to applying for a mortgage. So I had a client come to me who was a sole company director, and she was just going to use a massive dividend to release some money from her company to pay towards her deposit. That obviously meant a high tax bill for her. So we was having a conversation, and I just said, have you ever considered a director's loan to release some money for your deposit? Now, not all lenders do this, and it's not right for every company director. So what I advised her was that there are lenders that will accept it and it can be tax efficient, but you will need to take professional advice from your accountant. So off she popped to speak to her accountant to see if this was a viable solution for her and her company, which it was, which was fantastic news. So we gathered 3 years of accounts for the lender because they wanted to see the accounts rather than the tax calculations and the overviews. We got a letter from the accountant confirming that this would not impact on the company, and off we went to the lender. The lender agreed the case and issued the mortgage offer, which was fantastic because that made her tax efficient and she could still release the money from her company. So here are 4 things you need to consider if you're looking to use a director's loan as a form of deposit for your mortgage. Number 1, your accountant is going to need to write a letter to the lender confirming there's going to be no impact to your company and confirming if there's any monthly repayments, because if there is, those monthly repayments are going to be put back into the affordability and that could impact the amount that you could borrow. Number 2, the lender's probably going to want 3 years of accounts from you, or up to 3 years. They want to see where that source of funds have increased year on year and what source it's come from, and also confirm that it's really not going to impact on the business moving forward and there's still adequate money in the bank accounts to support the running of the business. Number 3, not all, lenders want to see the majority shareholder applying for the mortgage. So if you are, say, a 30% shareholder, they're not going to be as comfortable as, say, if you're a 51% shareholder. If it's a couple that's looking and they're both 50-50 directors, that's going to be fine if you're both going on the mortgage application. But in an ideal world, you're going to be a majority shareholder or a sole director. Number 4, remember, this is not right for everyone. It's really personal preference, and it's down to your accountant to see if this is going to sit right with you and your company and what impact it will have. So just because you're able to do it, it doesn't mean that you should do it. So just to recap, the 4 things you need to consider if you're looking to use a director's loan towards your mortgage deposit is check with your accountant first of all, make sure that's viable. Your accountant's going to need to write a letter and confirm any repayments on a monthly basis, what they are. You're going to need 3 years of accounts for the lender to review. And ideally, we need you to be a majority shareholder, or in best case scenario, a sole director of the company. And remember, it's not right for everyone. So just because you can do it, it doesn't mean that you should do it. If you want to know if a director's loan suits you, you need to speak to your accountant. But if you want to know how much you can afford if you take a director's loan, then just drop a comment below and we can have a chat.